From October through the end of November 2025, global markets operated in a clear late-cycle environment, marked by slowing economic momentum, declining inflation, and a cautious shift by central banks toward a more accommodative stance. Global growth is now projected at 2.8 to 3.0% as manufacturing and trade remain weak, while the services sector continues to prevent a deeper downturn. In the United States, economic activity softened noticeably. Consumer spending moderated, job creation slowed, and corporate investment remained subdued amid tariff uncertainty and political risk. With core PCE trending toward 2.6%, the Federal Reserve delivered its first rate cut, 25 basis points to 4.00 to 4.25%, and signaled that further easing remains possible. The strategic focus remains on quality large-cap equities, a barbell approach in fixed income, and maintaining 5 to 10% cash for opportunistic deployment. In the Eurozone, growth remained close to stagnation. Wage increases supported consumption, but exports were constrained by weaker global demand and continued trade frictions. With inflation declining toward 2.2%, the ECB implemented another 25 basis point rate cut. The preferred stance is neutral equities with an emphasis on defensive sectors such as healthcare, utilities, and consumer staples, complemented by high-grade corporate bonds. China maintained stable but moderate momentum, with full-year GDP tracking 5.1 to 5.3%. Domestic consumption and targeted fiscal support helped offset sharply lower exports to the United States, while intra-Asian trade strengthened. The yuan experienced ongoing volatility due to capital flow pressures and policy adjustments. Strategy calls for selective overweight in A shares, particularly consumption, technology services, and the EV value chain, alongside high-quality sovereign bonds and currency hedging. The United Kingdom continued to underperform, with growth below 1%. Inflation eased to 3.4%, though the Bank of England maintained a restrictive stance, signaling no rate cuts before 2026. Preference remains for FTSE 100 multinationals and short-duration sterling credit. Portfolio allocation, November 2025. A balanced, defensive, and quality-tilted approach remains appropriate. 50% equities, focused on quality, 35% bonds with duration and high credit quality, 10% real assets including gold, commodities, and listed infrastructure, and 5% cash to capture opportunities during volatility.